Joining us now from Blackrock, Amanda Lynam. If we are quiet now, why are the markets so distressed?
Good morning. Thank you for having me. I think what's been puzzling to us is that we've had, in our view, a trimming of the left tail risk on the trade policy uncertainty. But we're not completely in the clear in terms of the overhang and the potential hit to margins, as you were discussing in the earlier segment. Credit spreads are wider, but they're not reflecting a sharp downturn in growth. As for the yield backdrop, our colleagues in the Blackrock Investment Institute, I know you had weigh on earlier this week, we're expecting a steepening of yield curves and a rebuild of term premium in the long end. I think that's what that march higher in interest rates is reflecting.
For mere mortals like me who never look at this stuff, where do you glean the most information? Is it in high yield dynamics? Is it in short-term SOFR fancy full fit?
Sure.
Where does Amanda Lynam turn to learn what fixed income says?
I think the short-term funding repo markets are definitely important in times like this. We're staying in very close contact. They are. I would say liquidity is a bit challenged, but they're for sure open and functioning. For corporate credit investors, actually, the new issue debt capital markets has been a really important barometer of confidence during late 2018, during the pandemic, even during periods of the commodity disruption. The freezing of those capital markets during those periods of time did catch the Fed's attention. We know that. Right now, they're open and functioning, just at a higher cost. We're watching that very closely. The other thing at a more macro level is this feedback loop, this really important feedback loop, we would argue, between corporate margins, the layoff rate, which is still low, consumer spending, and overall economic activity. If pressures on margins are enough for corporates to flex that layoff tool more aggressively, we think that could really cause some concern in the broader economic backdrop.
How do you guys feel about credit quality out there in the marketplace?
It's an interesting question, Paul. In times like this, the reflexes often just move up in quality, so to speak. We're actually pushing against that a bit. We're actually fine moving down in quality within the investment grade universe because on net, those companies are very well positioned fundamentally heading into this. So we're fine moving into that triple B part of the capital structure. And then even into the high end of high yield. Actually, in recent years, especially since the pandemic, the fundamentals of the high end of high yield look very similar to the low end of investment grade. There's a lot more fluidity between that market in terms of issuers. So we're actually fine reaching down in there. That picking up of additional spread is going to be really important given the volatility in the treasury market to kind of cushion those total returns.
Amanda Lynam with us. I had a macro credit at Blackrock this morning. A lot of good conversations.
BlackRock's pretty big, aren't they?
Pardon?
BlackRock's pretty big, aren't they?
They're large.
Okay.
Yeah, they're on the edge of ginormous.
Okay.
You know, it depends if Jeff Rosenberg's having a good day. The most important quote I've seen here, and I put it out on Twitter this morning, this is from the Governor Waller, A Tale of Two Outlooks, a speech. This is Waller, folks. In terms of output growth, with large tariff increases, I would expect the U.S. economy to slow significantly later this year, and this slower pace to continue into next year. What will our listeners and viewers' debt instruments do?
Right. So that's not priced in to credit spreads, to the earlier point. There is some room for credit spreads to widen. Now, the magnitude of that growth downturn, we would argue, has yet to be determined. If you assume, like our colleagues in BII do, an average effective tariff rate of 20%, using the economic rule of thumb, that's around a 200 basis point hit to growth and a 200 basis point upward pressure on inflation. The one thing that I thought was really important from both Chair Powell and Beth Hammack's comments yesterday is that it seems that Fed officials are acknowledging that the dual mandate could come into tension later this year as unemployment increases and inflation potentially increases. That's the most important part of, I think, the commentary that I gleaned yesterday. And what that means is that it's not a given that the Fed will cut preemptively if we see signs of a growth downturn.
Private credit, I mean, you got to take responsibility for private credit. You're in the fixed income space. What is private credit? I mean, she's at BlackRock. I mean, they rule the world. Private credit, are we going to see some stress there, do you think?
So I think just like liquid credit, private credit is subject to the business cycle and a deterioration in growth. We are expecting an uptick, I would say, in liquid credit and private credit, in covenant amendments, defaults, that sort of thing. The one interesting point, though, is that in times of liquid credit market volatility, private credit has usually stepped in as a financing source for a wide range of companies when the syndicated markets don't function as they should, not because of actual fundamentals, but more so technicals, which are a broader conversation.
There's no gray hair. Excuse me. The blue button, the Detroit Lions blue button. There's no gray hair in the room. I remember that in every single crisis, the Wall Street angst is a surprise. These newfangled private credit, private equity things, do they have an internal leverage in them that makes them the next surprise?
The amplifying channels that were present during the financial crisis, when I was actually covering the insurance sector, they're not really there, Tom. And I think one of the maybe understated points on private credit, this is long-term capital that is locked up and is not really subject to run risk, for example, like bank deposits, right? So you're at matching long-term capital with long-term investments. That is going to be a stabilizing factor. Now, we should not be Pollyannish, though, but a credit cycle or an economic downturn will cause losses. But can we, bridging the gap, is that a systemic risk? I think is a bridge too far.
Fed Chairman Jay Powell, he's in the news today, probably not for the reasons he wants to be.
Right.
What do you expect this Fed to do over the next coming months? Is there any role they play here to, I don't know, calm the markets, to provide, I don't know, maybe greater liquidity?
Sure. So as it relates to monetary policy, we're not expecting them to be preemptive. So we view a rate cut in the first half of this year as unlikely, barring a really sharp downturn in the labor market. So, payroll gains 50,000 or less a couple months. I think they have calmed the market. When the 30-year hit 5%, we started to hear from Susan Collins and others that they were kind of watching conditions in the funding markets and ready to step in to deploy their very robust toolkit that is left over from the pandemic and the financial crisis. So I do think they're kind of waiting in the wings if market dislocation gets there. But volatility is different than a lack of functioning, and it seems that we're not there. We're not there at the moment.
One final question, and it's just as simple as this: everybody's going to go in flat over a long weekend. I mean, I get that, but the basic idea here is who's selling, making prices go lower in bonds. Is it foreigners selling? Or is it domestic selling?
Sure.
What does Blackrock say?
Sure. Well, foreigners own around 25% of the corporate bond market. So it's not just foreign holdings of treasuries or foreign holdings of equities. Actually, they're a meaningful participant. I do think that if you think about, actually, European credit spreads have outperformed U.S. credit spreads significantly over the past few weeks. And so I think while the U.S. had been a destination for capital for a lot of these foreign investors, that may on the margin retreat a bit. That being said, the U.S. corporate bond markets are still the most liquid, deepest, broadest market. So there's not a ton of substitution available in other markets outside the U.S.
Did I do that okay so you're not in trouble with Chris Meade?
I think that's great. I think he did perfect, yes.
Your badge will work today?
I think so, yeah.
Amanda Lynam, thank you so much at Blackrock here.